Hello everyone, this is Ryan Mallory for SharePlanner.com. Today is January 30th, 2012. Doing another market recap, trade analysis. Today I plan on just briefly flipping through some of these market charts that we have, like the Russell, the NASDAQ, the S&P. Also go over through some setups tomorrow that you guys might be able to pounce on for your own benefits. Just off the top thoughts that I have about the market today. Frustrating if you're a bear still, because you're still having to buy the dip mentality that's prevailing through the market each and every day. For the bulls, you're getting a sense that things are starting to slip out of the grasp, and concerned that we might be rolling over here, so there's going to be some profit taking. But really for the bears to pick up any ground, essentially they gotta basically kill the dip buying. As long as that dip buying persists, and it will continue, if we gap down tomorrow, you can rest assured that there's going to be an attempt to buy the dip again, and that's not going to happen until they can start failing at that exercise, because what's happening is that there's no fear in the market, there's no respect for the downside move, and as a result there's really no respect for potential risk, and that's where the dip buying is coming in. That's why it's so aggressive, because the respect for the downside is being compromised or greatly diminished. Real quick at the S&P 500 here, you can see we put in our third down day, but it's hardly a down day if you want to consider it. It's barely taken out this candle here in terms of price movement. And then before this price movement, you had 3 days of doji, so that's not really that hard to take out either. So the biggest move came from a gap up, and when we essentially just sold off and finished lower on the day. Best way to look at it is using the SPY, and you don't even have hardly any red filled candles this entire first month of trading. Two filled candles for the month of January, and that's quite impressive to me. Now the biggest thing is that we actually closed underneath the 10-day moving average by 1 penny. On the S&P 500 it was a little bit more decisive, but essentially you got to call that just closing on the 10-day moving average. I don't split hairs over a penny. So right now we're stuck right on the 10-day moving average. Whether we bounce off of that, I don't know, but price action had us below it for most of the day. The volume on the day was below average. Not much to talk about there. I'm seeing a lot of talk on S&P or on CNBC where they're talking about the S&P, saying that volume really doesn't matter anymore. We don't need to be paying attention to matter, and it's that kind of thinking where you start justifying divergences, saying, oh, that doesn't really matter, oh, that doesn't apply, oh, it's different this time, and that's where you get yourselves into trouble. And I would tell you this much, that almost every top that I've ever seen in the market was preceded by very, very, very aggressive dip buying, and I would say the dip buying that we're seeing right now is no less than aggressive. When I say top, I don't know if we're necessarily going to like plunge like we did back in August or anything else, but I do know that there's got to be a pullback of some kind. Maybe it's 3%, 4%, maybe it's 10%. I don't really know, but I can tell you this much: the bulls are primed to be shaken out of some positions here, and as a result, the market will go lower. Pull up the IWM, because that's not it. The IWM, it has been very resilient this year, even more so than the S&P, and until today we hadn't really seen that much weakness, and we finished at like 0.8% down today, but even the candle there, it's a doji candle. So the bears are really not showing that aggressive follow through on an intraday basis. It's gapping down, but it's just getting bought right back up. So while we were down today, the candle doesn't look all that impressive, and it remains above the 10-day moving average as well. I do believe that you guys see some kind of a breakdown in the candles to really get, or in the Russell's candles, to really see the movement across the broader markets first. Right now it's lagging to the downside, so that is a concern for bears to pay attention to. The QQQ, you can see here it's never looked better, just going way out. It's breaking out to new highs. Today it was actually up. bounced off the 10-day moving average as well, right off the open, dipped a little bit below, finished higher. Volume once again below average. And another thing to note, in the very near term, some of the indices are working off overbought conditions, as you can see here with the SPY being at 42. But then you look at some of your more long-term indicators like T2108 lines here. I know there's a lot of moving averages, but ignore that. This one here, you can see it's at 82, and historically you can see here that it tends to top out right here at the top of the range, which is where it's at right now. So, and wanted to go ahead and look at a couple of stock setups here too that might be of interest. Get back to the candles here. NLST lag, you got a nice solid uptrend here, and then you also have a clear level of resistance, an ascending triangle per se, that could allow for it to break out higher. However, if it breaks this trend line here, I think it's going lower. Head and shoulders pattern, inverse head and shoulders pattern right here. So things look pretty good from a technical standpoint. You can go long or short depending on which barrier it breaks first. Denny's, DENN. I actually went there the other day and had one of their breakfast skillets at like 11 o'clock at night. Besides the fact that it kept me up for most of the night, it was pretty darn good. Alright, so at 431 you have a breakout play here. You can see there's a clear area of resistance. Draw the line so you can better see that. Right about there. I know you got a bunch of head fakes, so that's one thing to be concerned about, but overall it looks like a pretty decent trade opportunity there. MOBI. Another inverse head and shoulders pattern. You got the left shoulder, head, right shoulder. If I'm drawing the line, your confirmation point is somewhere like right there. Head fake today, absolutely, but you can see here that if they can close above it, and it did so, has some nice volume pouring in above 411, it should be good to go. I like the MOBI chart, I really do. Tan. Another inverse head and shoulders pattern. Boom. Seeing a lot of these days, but entry on this one is a little bit harder to figure out. A little bit concerned about this resistance here, so I might wait for it to get a little bit into that area before I actually traded it. Or you could say like 319. That would put you right below this price level there that could stop it in its tracks. So you go 319 if you want to be high risk, or you can go maybe somewhere around like 329, 330 for a lower risk. They both have their own risks. You know, if you get in later, then you might have missed the big chunk of the move. If you get in early, you might not. You might be throwing away money at a move that never happens. CIGX. You got a lot of support down here. You got a downtrend going on here, and then you got some consolidation going here. Volumes coming in nicely. If you were to go long on this, let me draw the line for you. There you go. Right there. So you got support here, you got resistance here, and you got some resistance there. So probably above 319 would be good for a day trade. So, all right, that's going to be about it for today. Wanted to make it short and sweet so you guys could get about your evening duties and enjoy your time with family. And if you have any questions, always feel free to hit me up, Ryan at sharepointer.com.